Well, the Federal Reserve has cut interest rates for the third time this year as growth in the US economy continues to slow. The central bank lowered its benchmark rate by 25 basis points on Wednesday to a range of 1.5 to 1.75%. It signalled rates would remain on hold unless the economy takes a sudden turn for the worse. The US economy slowed to an annual growth rate of 1.9% in the third quarter, the slowest this year. Trade disputes with China and a general global slowdown have been taking its toll on the world's largest economy.
Today, we decided to lower the interest rates for the third time this year. We took this step to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risks. As I will explain shortly, the policy adjustments we've made since last year are providing, and will continue to provide, meaningful support to the economy. We believe that monetary policy is in a good place.
Well, for more on this, Daniel Lacalle joins us now from Madrid. He's chief economist at asset management and broker-dealer Tressis. Welcome back to Money Talks, Daniel. We heard there from Jerome Powell, the US Fed chair. Everyone pretty much expected this 25 basis point cut. But what signs did Jerome Powell give in terms of what it will do in the future?
I think it was a very interesting group of messages, because if we think about what he said, on one side he said that the Fed was going to use all of the tools that it has available in order to address any type of slowdown and to support the economic growth. However, at the same time, I think he was quite trying at the same time to avoid people from becoming too aggressively expecting further rate cuts for no reason. So I think that what he was trying, the message that he was trying to give was, on one side, to be slightly dovish, 25 basis point cut, and at the same time remain positive about the US economy, whilst not encouraging excessive risk taking from market participants expecting very aggressive or dovish policies.
So from the press conference that Jerome Powell gave, do you believe that the US Fed will hold off from further rate cuts for now?
Well, if we look at the data, purely on data, the reality is that the US does not require another basic 25, 50 basis point cut, because the economic growth, 1.9% above expectations. At the same time, inflation is at 2%, core inflation. Additionally, unemployment, 50-year lows. So it does not necessarily need a rate cut. I think that the reason why we're seeing these rate cuts is because the Fed is reacting to a very dovish policy of the ECB, the BOJ, and the PBOC. And as such, what we are likely to see is probably more of that. And if I have to think of something, is that if the economy continues to be as relatively strong, again, there's a slowdown, but relatively strong as the US economy is right now, the Fed should hold on and not raise and not change or cut rates any further, because it needs tools to address a real slowdown. The ECB fell into the trap of being extremely dovish and extremely accommodative when the economy was growing, and now it's run out of tools.
Okay, Daniel Lacalle, we'll have to leave it there, but thank you so much again for your analysis here on Money Talks.